If you would have heard Kabir Shakir 2-3 weeks ago, you got a sense about what they're trying to do at Tata Com. There will be near-term stress on margins as they integrate some of the acquisitions, in particularly Kalera, which is a CPaaS player which they've bought recently. I mean, recently in the scheme of things of the acquisitions that they've done. But the questions to him at the start of FY25 would be, how does he view what would happen over the course of the next 1 or 2 years, considering that in some sense, the last 2 or 3 years on the revenue front have been years of consolidation as voice revenue comes off, but data revenue goes up, and at a point of time when the return ratios have really zoomed. He's CFO at Tata Communications, joins us right now on the show. Kabir, great having you. Thanks for taking the time out. Put this quarter into perspective, Kabir. Would you say that relative to what was anticipated, it was a bit soft, or was this in line with expectations? I was reading a couple of notes which were saying that their expectations were slightly higher than what you've delivered.
Actually, we're quite happy, I would say, Neeraj. Yes, there are a bit of a macro headwinds on the top line, growth, and maybe, we would have been happier with a little bit more. But I would like to underpin and underline the fact that our participation levels have gone up, when it comes to bids and customer conversations, and I've kept on harping this, that our customer relevancy is increasing, quarter on quarter, from any data point that we want to look at. So from that perspective, I think that's encouraging. Yeah, could the orders have closed, and revenue delivered? Yes, that could have been a little bit more than what we would have liked and what market expected. But I'm overall quite happy. Let's put this in context. We have for the year delivered a 22% data growth. For the quarter, it's a 27% data growth. So I think that's indeed a good data growth. Yes, on the back of acquisition. Even if I strip out acquisition, we are talking about an 8.8% data growth for the full year. So I would say, quite pleased with where we are.
So Kabir, we were not able to talk some numbers and timelines last time we spoke because you would have been a silent period. I think the street may be interested in knowing this. When does this, how do I say, you juxtapose both the things that voice naturally will go down as you develop the business, data will go up. When does this change in a way that in absolute revenue terms, we see very, very visible growth? Because your return ratios tell a completely different story from the consolidation picture that the top line is showing, right? So is there a timeline in mind about when does the growth in data revenue outstrip the loss of growth in voice, and it starts showing in the reported numbers for Tata Communications?
It is already showing, Neeraj. If you actually look at it, our voice business is becoming smaller and smaller. So yes. Today we are talking about less than 15% of the voice business, being smaller. We manage that business with very different metrics. I mean, it is not, gross revenue that we manage this business. We manage this business on gross margin. I mean, as our net revenue, as we call it internally. So we will manage that business for net revenue, for cash. And so the metrics are quite different for that business. The business globally is declining while we are maintaining share, or I would say improving share, from what we are doing. Data revenue, you will see both as a result of, organic and inorganic activity will continue to keep going up. And within data revenue, as I had spoken earlier as well, our near-term ambition is to bring a balance of 50-50 between core connectivity and the digital portfolio. We are already at 59-41, as we close the year. So we've moved from 68-32 that we were there last year as a ratio between these two businesses to 59-41, and that was also because of the 3 acquisitions, all of which we did was in the digital space. Therefore, I would say you'll already seeing all these growth numbers in our results.
Good morning, Kabir. This is Tamanna here, and great to speak with you as well on NDTV Profit. Just a follow-up there on EBITDA margins, and you talked about the acquisitions, the 2-3 acquisitions. They have diluted your, understandably, your EBITDA margins to some extent, and you're seeing that in the quarterly and yearly numbers. When do you think you come back to the 23 to 25% range that you have guided in Q3? Do you have sort of a timeline for that?
Yeah. Good to see you and talk to you, Tamanna. We have stated that that's our ambition range that we would like to operate in 23 to 25. I would like to again remind, even though we stated that as the ambition, we operated north of 25 while we were in the COVID period when costs had not were not being incurred, whether it was travel or marketing or all of those spends. As we come out of COVID and all of these costs come in, there were a couple of things that we have done, together. Inorganic activity is definitely one of them, and that is mathematics. Everybody can do the weighted average math and what impact it had on our margins. But we also are investing in future capabilities within the organization to be relevant to our customers, to do all those things that we want to do from a top line perspective. So our three, guidance or rather guided, KPIs that we've given to the market is our leverage levels, our return on capital employed, and and EBITDA. And why I keep reiterating that it has to be seen in holistic perspective of all of these three together. Our net debt to EBITDA stated ambition is that we will be under 2x. We operated well under 2x for a majority of the last 3-4 year period. We kind of hit a great point of 1.3x before the acquisitions. We went up to 2.2. I mean, we are marginally down this quarter to 2.16. And we will get back in the under 2x range, and that will happen already in FY25. ROCE will follow and maybe happen year after, and EBITDA will be the last one to come back into the 23 to 25 range. So maybe 2 years is what I would be looking at EBITDA to come back into the 23 to 25 range. Having said that, what we will do between now and 2 years, is the world is not static, the market is not static, the competition is not static, the consumers' demands, are not static. So this for me is dynamic, that we will continue and have that virtuous circle of growth. And when I spoke to Neeraj last time, I talked about what's our finance strategy. Our finance strategy is to drive competitive, sustainable, profitable growth. And when we do that, and we get the benefit of that, we will reinvest back into the business to drive further growth. And therefore, that's where we are headed. I'm pleased to see that that's what is playing out already today.
Okay, that's great. So 2 years out for a 23 to 25%, EBITDA margin as things stand today. Now, one big factor perhaps is the amount you need to invest on network expansion, network expenses, etc. Can you give us a sense of what direction that's going and how that will increase?
Yeah, I would talk overall capital expenditure, Tamanna, not just network alone.
Okay.
Because we're going to invest quite a bit in these new technologies. You've already seen our announcement of the partnership with NVIDIA on what we intend to do on AI cloud, and that's just a start. The board has in principle, given us the go ahead to go and invest, something to start with, but we will, and as we see use cases coming in, as we see that relevance hitting with our enterprise customers, that's one area which we will, increase. So when we guided the market earlier saying we would be in the 250 to 300 million range for capital, hopefully in FY25, I would be north of the 300 million. And that's the kind of line of visibility that I already have of the projects that we are doing. And that's the reason why the ROCE target becomes extremely important, that while we increase our capital outlay in the business, we don't take the eye off the ball in terms of returns. And so therefore, these things therefore work hand in hand, if I may.
Okay. That, Kabir, just coming on the NVIDIA deal, and that's really exciting. That sounds really exciting. Can you give us more clarity on what exactly are you going to be doing with NVIDIA? And is this going to service the larger Tata group? Can you give us a bit more color there?
We are actually, today crossing all the T's and dotting all the I's in terms of first getting the infra up, right? And even just getting the infra up, the kind of power consumption that these data centers need is of a very different order of magnitude that none of us in the industry have ever, done before. So that's the infra play that is happening. In parallel, we are in discussion with multiple, organizations, with the government, with enterprise customers, and I will also say within the Tata Group as well, as to what are the potential use cases where this can be used. Initially, to start with, I would say, Tamanna, lot of effort, lot of the GPU usage will go on training the models, and then fine-tuning the models, and then inferencing. So those are the three components of it. I think the training the models is where a humongous amount of computing power, networking power is all going to be used. And we're quite excited as to what that will unfold, and we will be positively surprised about the multiple use cases that we will do. So quite excited about it, and that's definitely the place where we would like to keep our investment antenna and prioritization up, as we get into the future.
Kabir, just one final question before we let you go. A lot of times companies move up a certain curve and then see a bit of a J-curve effect coming in on various aspects. You've seen that happening in your case on the quality of growth, the return ratios, etc. Do you reckon that as you do all these exciting things that you're doing over the course of the next 3 years, maybe you take your margins higher as well, but can the quality of your growth, which is the return ratios, move up even higher as the pace of revenue growth and margins also move up from where it is right now?
Neeraj, that's why I have given the guidance in a range, 23 to 25 EBITDA, greater than 25 for ROCE. And this is not cast in stone, as you rightly say. As the environment moves up, as the context move up, we will kind of re-establish all of these benchmarks, and we question that. And the last thing that I want in an organization like Tata Communications is complacency to set in. I am not going to sit back on my past laurels. We are going to keep challenging ourselves, keep challenging the status quo. And therefore, if we need to reset, of course we will reset. Because let's take the example of AI Cloud. If it demands a certain investment, for a certain period, and the returns will actually flow in later on, we're not going to be shy of making that investment. Equally, in mature businesses where I would need a return under a year, we're going to put the pressure to deliver that. So horses for courses here. It's not a democratic thing that everybody is going to get in one same way. Mature businesses are going to be treated differently. New sunrise businesses are going to be treated differently. Equally, certain assets where we had invested in the past and we are not delivering returns, they're going to be treated very, very differently.
Okay. Fair call, in line with what you had spoken to us earlier as well. But Kabir, all the best for the quarters ahead and for the year ahead. Thank you so much for speaking to us today on your quarterly and the annual numbers.